Hello everyone, welcome to this next session by Wisdom Mitra about RBI currency and monetary policy. In today's session, we would be covering very important topics. For example, overview of RBI, when was it formed, under which act, who was its first governor, who's its current governor, so on and so forth. The governance of RBI, basically it means who is responsible for RBI, what's the size of the committee, etc., etc. Important functions of RBI. What does exactly RBI do? Then relevant acts that are pertaining to RBI. Then all about like money flow, inflation control, etc. What exactly is that, and how does RBI accomplishes it? The next point would be about monetary policy framework, and then where exactly is currency printed in India? You know, both coins and currency notes. And then we would be covering a few questions related to this topic that have been previously asked in UPSC and in other examinations. I hope you would enjoy this session. Let us dive. RBI. RBI got established on 1st of April 1935. This date is very important. It has been asked multiple times in multiple exams. It has been created in accordance with Reserve Bank of India Act 1934, based on the recommendation of Hilton Young Commission. So this again is an important point. Based on which commission recommendation? It's Hilton Young Commission. RBI initially was a private bank and it was nationalized in 1949, and it is currently fully owned by Government of India. The third important point is RBI initial headquarters was in Kolkata, but eventually it moved to Mumbai very early, back in 1935, 10 years before independence, to be frank. A few important points about governors. The first governor was Sir Osborne Smith, and he was probably an Australian. The first Indian governor was Sir C.D. Deshmukh, and this person has represented India in Bretton Woods conference as well. One of he was part of that delegation. And Bretton Woods conference, I believe you all know, it's one of the most important conferences that happened in 1944. And the current governor is Mr. Sanjay Malhotra. Again, this question is asked in multiple exams. Who's the current governor of RBI? So you need to know. As of now, when this session is being recorded, Mr. Sanjay Malhotra is the governor of RBI. RBI has 33 offices, locations, and 5 training establishments. Not usually asked, but good to know point. Governance of RBI. RBI is managed by a board which is not more than 21 members. And the breakup of those 21 members is official directors and non official directors. Among official directors, the governor, who's the most important person, and then not more than 4 deputy governors. So these 5 people put together make official directors. The non official directors, 10 directors from various fields, 2 government officials, and 4 from each local board are part of this delegation. So, like 1 plus 4 is 5, 10 is 15, and 2 17, and 4 21. These 21 make the RBI governance board. Okay, and the local board of RBI is constituted for Western area, Eastern area, North, and South, right? And it consists of 5 members each. Again, these members are appointed by central government. They shall hold office for 4 years. Okay, uh, let's move forward and understand functions of RBI. These are like really important points which we need to understand and know. The most important responsibility of RBI is monetary authority. Basically, it formulates, implements, and monitors the monetary policy. What is monetary policy? Monetary policy is nothing but control of money within a geography, within an economy, within a country, within a nation. Okay, So maintaining price stability while keeping in mind the objective of growth. This is like the most important responsibility of RBI. We would delve deeper into how is that done as we move forward, but let us first understand all the other functions of RBI. The second most important function is a regulator and supervisor of financial system, basically banks. So basically, RBI is responsible for performance, behavior, and broad parameters that would be the governing responsibilities of banks. So, it kind of formulates high level rules about how to maintain a confidence in banking system, how to protect money of depositors. Everyone puts their money in the banks. How will that be protected, etc. For example, why there's this one news clipping that I've clipped from Times of India, and in here it kind of points out about Paytm being banned um, from banking. The Paytm, which is a company which is into payments and all, it has been banned from making to be in the banking. Again, the reasons were multiple in the sense that Paytm was acting like a aggregator, like an e-commerce platform, as well as a bank, and the same infrastructure, the digital infrastructure, was being used. This kind of violates the privacy and protection of depositors, that kind of stuff. So always RBI takes care of such perform activities and kind of regulates the system. So second most important point after monetary policy would be regulatory supervision. The third important point about RBI's performance is managing of foreign exchange. So RBI is responsible for handling foreign currencies within India to facilitate external trade and payment and promote orderly development and maintenance of financial market. Fourth important point is it is issuer of currency. Basically, the first and the fourth point are kind of related. We'll see how, but it kind of issues, exchanges, and destroys currency notes, as well as puts into circulation the coins minted by Government of India. There's a important differentiation here, if you notice. Coins are always minted by Government of India, and higher level currency notes they are always printed by RBI. Okay, so coins are never minted by RBI. Coins are minted by Government of India, but are handled by RBI. And this is meant for like providing adequate quantity of supply of currency, right? And availability of enough currency, it kind of helps growth and growth of an economy, as well as it kind of helps exchange and transaction. Next important point is performs a wide range of promotional functions to support national objectives. If a sector is supposed to be supported in terms of availability of finance, etc., it kind of provides some broader guidelines, inputs, ideas, etc. Next is its regulator and supervisor of payment and settlement systems. So it's slightly different from banking systems because some payment systems they are not into banking, but they are into payment settlement, etc. So even this work is handled by RBI, and there are other related important functions. For example, it's banker to the government, meaning it performs merchant banking for central and state governments. So basically, central and state governments, their money is deposited in RBI. It's handled by them. It's kept by RBI, right? And also acts as their banker. Next is banker to banks. It kind of maintains banking accounts of all the scheduled banks. So any bank that's registered in India, it would have an account with RBI with which it kind of exchanges currency, maintains, and all that. These are the most important points. Let us go through again. Monetary authority, regulator and supervisor of financial systems, manager of foreign currency, issuer of currency, development role, and payment settlement systems, and banker to the government and banker to the other banks. Let us go a bit further and understand what are the relevant acts that help RBI perform and function. The first important point is Reserve Bank of India Act 1934. This is the most important act when it comes to RBI. So RBI derives many of its powers from this act. Then Public Debt Act, Government Security Regulation, Banking Regulation, Foreign Exchange Management, Credit Information, Payment and Settlement, Factoring Regulation Act, etc. Let us now understand what is inflation before delving a bit deeper into monetary policy and all that. So the point usually that's spoken about is that RBI controls inflation. But how does it do that? What is inflation? Inflation is nothing but rise in prices, right? How does the rise in prices happen? One reason would be, suppose supply is lesser for products. For suppose there are like bread, the need of bread, and suppose the demand is very high for the bread. There are suppose 100 people who need bread, whereas there are only 50 breads that are available. What would happen in such a situation? Obviously, the person who's selling the bread, they would say, I need higher price. So suppose the bread is being sold for 10 rupees. What that person would do, they will increase the price to say 15 rupees to sell the bread, because they know that the demand is higher for the breads that are only 15 quantity available, but there are 100 people who need that bread. So this increase of price due to supply shortage and demand rise, this is called as inflation, right? But now, if you would like to understand, there is a much more common reason for inflation. What is that? The reason is, again, this inflation is rise in prices. That's same. What happens is that, suppose there are again supply and demand, and imagine that there are like say 90 breads available, and there are 100 people who need the bread. And in such a situation, imagine what happens is that these 90 people have, each person has 10 rupee in their hand, and their only need is bread as of now. Suddenly what happens, imagine that everyone got say 15 rupees in their hand unexpectedly, and this is the only need as of now. Just imagine for the sake of simplicity. And what they would do is, again, since the demand is by 100 people and supply is only 90, all of them would run behind these 90 breads to get the bread. And when the seller of the bread sees that I have only 90 breads and you are 100 people, I need a higher price, everyone would say, I'm ready to give you 15 rupees because this is my only need, and I have 15 rupees available with me rather than 10 rupees. So basically what happened is that this there was not a drop in supply or something. There was no rise in demand or something. The only factor that changed was the amount of currency available in the hands of people. It suddenly increased, and that in turn impacted the demand price, right? Basically, the price increased because people have more cash in their hand and they are ready to spend it. So, effectively, inflation happens when there is same products like more currency chasing same goods and services. So, which this is the most common reason for inflation that happens. You can check, inflation in Zimbabwe or say Germany between First World War and Second World War. You'd realize how the bad policies of the government made economy of these two countries really suffer. Because in Germany, what happened was that government borrowed money from the people, and government did not had uh, enough money or a source of income to cater to the loans. Whatever loan it took from the people, it did not have enough currency to pay back those loans. What it did, it simply printed extra money and it gave back the loan. Effectively, what happened is that people got more cash in their hands while the available products were same. In fact, because of First World War, they were not having enough production, and in such a situation, they had more currency in their hands, and because of that, the currency lost its value completely. The same situation more or less happened in Zimbabwe as well, not during the world wars, but much later. Again, there was this like loans and all that. So you can understand how important is maintaining the right flow of currency. If the amount of currency in an economy is lesser than required, it would straitjacket the economy. People will not be able to make transactions with each other. Whereas if the currency is available more than required, then it will lead to very high inflation. It will lead to loss of value of that currency, of that money. And people who are saving money, they would lose their value even without spending. So imagine I have saved my 100 rupees, and because of higher availability of currency, now that bread turned available even in 100 rupees. Like people are ready to give 100 rupees for the same bread, which earlier used to be like 10 breads. So my value dropped even without me spending anything. Those 100 rupees became value of like just one bread rather than 10 breads. So this is what happens to people who are saving in the form of currency during like long duration. If the inflation is persistently there, it kind of eats away into their savings even without realizing. So that you have to understand. So inflation, the most important common reason is more currency chasing the same goods rather than shortage of supply. That you should really be clear about. Now, having understood this, let us now see how RBI, or as a matter of fact, any central bank whatsoever in whichever country, controls this flow of currency in an economy. It controls the flow of currency in an economy by regulating the rates of interest, various rates of interest. What are those rates of interest? One is repo rate, second is reverse repo rate, third is bank rate. What is repo rate? This is the rate at which RBI lends money to the commercial banks for short term need. So, like basically, RBI provides the banks money for doing short term transaction with a collateral. Some allowed collaterals are there, for example, government bonds. That's one collateral. So, basically, RBI gives money to banks and at an interest rate. And suppose RBI wants to suck away currency from an economy. So, this is an economy. So, imagine, and from this economy RBI wants to get the money out. If it wants to get the money out, what it would do, it would increase the repo rate. Once you have the higher repo rate, then the banks will find it difficult to borrow money from RBI to put in the economy, to give it to people. And because of that, they'll take lesser money, and because of that, you have lesser currency floating in an economy. So by increasing the repo rate, RBI can reduce the currency, right? Increase of repo rate, reduce the currency. Similarly, is the reverse repo rate. This is the rate at which RBI borrows money from the commercial banks. So again, suppose RBI wants that the money in the economy should be sucked out, should be removed. To do that, what does RBI do? It will increase its repo rate. Okay. So once the repo rate increases, that means rate at which RBI borrows money increases. RBI says to a bank, I'll give you say 5% on the money that you deposit with me. And a bank thinks that suppose I am like previously I used to get only 3% from RBI. Now I'm getting 5%. What the bank would do, it will increase the amount of money that it deposited with RBI rather than giving it out as loans. So basically, the money which was being given to common people now goes to RBI. This is the way in which the money in circulation is taken away from the economy. So this is the reverse repo rate. Third is bank rate. It's same as repo rate. The only difference is that it is long term and it is without any big collaterals. So by these three methodologies, RBI controls the rate of interest, and through rate of interest, it controls the currency flow. Is this clear? Hopefully, yes. Right. What's the second method that RBI uses to control money flow and inflation? Second is open market operations. Basically, RBI sells government securities to public and banks. This absorbs excess liquidity from the market, reducing the amount of money available and thereby controlling the inflation. So again, this is nothing but RBI says I have bonds from the government, that is government wants loans. Government need loans, and RBI sells these loan bonds. That is, say, government needs 10 rupees loan, for example. It would be in thousands of crores, but yeah, just an example. So it would sell a $10 bond in the public out there, and people would buy it, considering that it's a safe investment. And through that money, which was there in the hand of, say, I'm there, I have 10 rupees with me. Instead of, taking this money and buying something, I'm giving it to the RBI and buying that bond. So this is called as open market operation, where RBI sells government bond, government security, and takes the money away from the public. Third is by controlling some statutory ratios. What are those ratios? These two are most important that you should remember. One is cash reserve ratio. Second is statutory liquidity ratio. First, cash reserve ratio. This is a percentage of total deposit that commercial banks are required to hold reserves with RBI. So basically, imagine this: you are there's this RBI, and there's this bank. Suppose I call it Bharat Bank, for example. I don't know whether such a bank exists, but yeah. So now, in such a situation, this particular bank cannot have all the money it has sent out as loans. What it's supposed to do? It's supposed to put some money with RBI, right? And this some money is basically dependent upon how much money does this bank has. So if this bank has, say, uh, you know, suppose the CRR, that is cash reserve ratio, is 10%. So if this bank has 100 rupees, then it's supposed to keep 10 rupees with the RBI. Suppose this bank has 1000 rupees, then it means with the RBI, this bank is supposed to keep 100 rupees. So if RBI wants to suck away some money from the bank, what it does, it simply increases the ratio and says, I need 12%, not 10%. This means it would keep 120 rupees with RBI rather than just 100, right? Instead of 100, it becomes 120 if the percentage increases from 10 to 12. So that's how RBI kind of sucks away money from the banks. Again, it would do in the reverse manner also. Suppose it wants to put in some currency in the banks, what it would do, it would say instead of 10%, keep only 8% with me. That means if a bank has 1000 rupees with it, only 80 rupees it's supposed to keep with RBI. Remaining money, it would be able to manage, handle, use for giving away loans to the people, which in turn would put money in the hands of people. Second is statutory liquidity ratio. Basically, this is the ratio that banks are required to maintain with themselves. So suppose this is the 1000, and like suppose 10% is the CRR. That means the remaining 900 is available with this bank. This 900, the bank cannot give away as loans completely. Suppose there is this 10% again SLR. What that means is that out of this 990 rupees, the bank is supposed to keep with itself, and remaining amount of whatever 810, it's supposed to give away as loans. This 90, why is it supposed to be kept? Because it is supposed to handle withdrawals. So suppose I have deposited 5 lakh rupees with a bank. Imagine that, right? I will not withdraw all the 5 lakh simultaneously. Right? Sometimes I need 1 lakh, sometimes I need 50,000, whatever. So to handle these kind of withdrawals, bank is supposed to maintain some money with them, and that is what is called as SLR. And this ratio again would be dependent upon if RBI wants to keep more money with the people, what it would do, it would reduce this SLR. If it wants to keep less money with the people, it would increase the SLR. So again, this is one method using which RBI controls the money flow in the people's hand. Next, so basically, these are the two three methods. One is interest rate, second is government bonds, third is statutory ratios. Next, what is the currency system in India? This is a question that has been asked a few times. This is nothing but India maintains a minimum reserve system, right? Rather than say gold standard, which is another extreme, or say simple fiat money, which is like the other end of the spectrum. What is gold reserve system? Gold reserve system means a country's central bank has to back all or a large portion of its currency issuance with gold. This is the most important point. All or a large portion. That's called as gold reserve system. And many countries had this system previously. While minimum reserve system allows for more flexible by requiring only a fixed minimum amount of gold and foreign reserve. Whereas in the minimum reserve system, it is supposed to maintain some amount, not like proportionate or something. So, India follows this minimum reserve system, whereas previously many countries used to have this gold reserve system. And what was the drawback of this gold reserve system? It was nothing but, you know, every need of currency was dependent on a single metal. In the sense that suppose an economy is growing at 5%, imagine that, right? So its currency needs will also increase simultaneously by 5%, kind of, more or less. But imagine that the gold being produced in that country is just increasing by 2%, because say mines are not available, mines are being dug slowly, etc. That means the gold available with the currency issuing authority is probably going to increase with only 2%, right? If it tries to buy more gold, it will cause shortage, etc. So the currency is growing at 2% because every single rupee which is being issued by the central authority, central bank, is supposed to be backed by gold. In such a situation, the currency will not be able to cope up with the rate of growth, which will hamper the growth. So that's the reason why gold reserve system kind of creates problem, and it was one of the major issues for 1929 economic depression. Okay, so now coming back to our conversation about what does India follow. India does not follow gold reserve system, it follows a minimum reserve system. That means India maintains some amount, right, of basic reserves so as to bring or keep some confidence, but it does not back every single rupee with some gold. Okay, so India maintains 200 crore worth of reserve as of now at this point of time when this session is being held. 115 crore of which is always in the gold form, remaining can be kept in the foreign currency form. So this is what is called as minimum reserve system. There are some countries that follow only the fiat system. Fiat system is nothing but a country prints as many rupees or currency as it wants without any backing of gold, etc. And here it's very important that the currency is being maintained in some proportion. Otherwise, if the country starts printing as much money as it wants, its value would drop. It's again, and it would create an issue. So again, that's what we were talking about, right? About Zimbabwe, about Germany. So that's what happens if the fiat money is not being managed and handled properly. So basically, you might have understood the different currency systems. As of now, India follows minimum reserve system. That's something you need to know. And gold reserve system is nothing but every single rupee is backed by gold, or almost every single rupee is backed by gold. India does not follow that. Previously, many countries used to follow that. And the third End of the spectrum is fiat money, where there's no reserve that's maintained. It's all about the consideration of the government in question. Next, one important point is monetary policy framework agreement. This was done between RBI and Indian government back in 2015. There are a few important points that you need to know. Most important of which is inflation target of RBI. As of now is 4 plus or minus 2%. That means the inflation is supposed to be always between 2 to 6%. And if RBI is not maintaining that for 3 quarters, then it's supposed to give a written report to Government of India explaining the reasons, remedial action, and target timeline to get back in that range. So this is one MOU you can say between Government of India and RBI. Most important point of this MOU is this 2 to 6% the inflation rate. Okay. Monetary Policy Committee, right? So for maintaining that range, we India has formulated a committee. Previously, these bank rates were fixed by governor only and no other authority. But now it's being handled by Monetary Policy Committee, of which governor is a very important member. This has been constituted as per RBI Act 45 ZB. You need not remember 45 ZB even maybe, but you should for sure remember this RBI Act of 1934. And just to give you a timeline of like when this committee started functioning is 2016. It determines policy interest rate for inflation target. What is policy interest rate? It's nothing but those 2 3 rates that I spoke about: reverse repo rate, bank rate, right? And RBI's monetary policy committee is supposed to meet at least 4 times in a year. That means every quarter. It is a 6 member committee, and quorum for the meeting is at least 4 members. And again, in case of tie, because it's a 6 member committee, so they want like sometimes people might be like 3 3 on both the sides, right? Whether we need to increase the interest rate or reduce the interest rate, or like if it is supposed to increase by how much percentage. All those considerations, questions are asked, discussed and decided based on the growth needed, inflation that's happening, etc., etc. So in case of tie, governor has second or casting vote. So like each member can give their vote and then governor can give the second vote if there is a tie. So this is the structure of monetary policy committee. Next, sometimes this question is asked: where is currency printed across in India? Or you would be given a bunch of locations and you would be asked in which of the following locations currency is not printed or is printed. So for coins, currency is printed in Mumbai, Hyderabad, Kolkata, Noida. And all these 4 locations, the mints that are there where currency is where coins are minted, they are all owned by Government of India. As I showed previously as well, coins are printed by Government of India and it's like only handled by RBI, not minted by RBI. Coming to the printing presses for currency notes, there are 2 printing presses, one in Nashik, one in Devas. These 2 are owned by Government of India, and one in Mysore, another in Salboni, and these 2 are owned by RBI. So you need to know that these 2, Nashik and Devas, they are government owned, whereas these 2 are RBI owned, Mysore and Salboni, Nashik and Devas. So like these are the 4 places where currency notes are printed. Again, this difference, right? Here coins are printed, whereas currency notes are printed. Now let us glance through a few questions that have been asked previously by UPSC or other, examination authorities pertaining to this topic. One question that we see over here: consider the following statements. RBI mandates all listed companies in India to submit a business responsibility and sustainability report. Second point is, in India, a company submitting BRSR makes disclosure and report that are largely non-financial in nature. Which of the above two is correct? So we understood through the session that RBI does not tackle anything non-financial. This is about sustainability, which RBI is not concerned about. So basically, only two is correct. whereas one is not correct because RBI is not responsible for sustainability. Let us see next. Which of the following are source of income for Reserve Bank of India? How does RBI makes money? Buying and selling of government bonds. Yes, this is true. As I told previously, it like issues bonds. Second is buying and selling of foreign currency. Yes, this is also true. RBI handles foreign currency. Lending to private companies. No, RBI never lends to private companies. It tackles only banks. Pension fund management. No, RBI does not manages pension funds. Printing and distributing currency notes. Yes. So basically, RBI issues a 100 rupee note, and it means it has created money out of thin air. And suppose the cost of printing that 100 rupee note was say 5 rupees, that means 95 rupees is profit of RBI. So basically 1, 2 and 5, these are the 3 points that are correct, whereas the other two are not. Next question. Governor of Reserve Bank of India is appointed by central government. This is true. Certain provisions in Constitution of India give central government the right to issue directions to RBI in public interest. Let us see. Is it correct? The third is Governor of RBI draws his power from RBI Act. Basically, this is for sure true. This is also true. And the third point, it says Constitution of India gives central government right to issue directions to RBI. No, because Constitution of India never spoke about RBI. There's no article in Constitution that speaks about RBI. It's the RBI Act 1934, right? Which has been created, formulated, amended multiple times by Parliament, not by Constitution. So point number two is wrong. Basically, one and three only are correct. Let us see the next question. If RBI decides to adopt an expansionist monetary policy, which of the following it would not do? One is cut and optimize statutory liquidity ratio. Basically, statutory liquidity ratio that we just saw, it kind of is the ratio that the amount that the bank is supposed to keep with itself, the amount of money. So if it wants to increase the money in the hands of people, that's what is expansionist monetary policy meant by. It has to expand the economy, it has to put in more money in the hands of people. If it wants to do that, for sure it will do cut and optimize the statutory liquidity ratio. That is, it will reduce the ratio that it wants to be kept within the bank, and it will allow more money. So yeah, it would do this, so it's not the point that we need to pick up. Second is increase the marginal standing facility rate. Marginal standing facility rate is nothing but repo rate. It's a different name for repo rate. The rate at which the RBI gives loan in the to the banks or in an overnight fashion, for short term. So if this is there, right, if it increases the this interest rate, right, it would mean that the bank will not be able to take more money, right, and that means the bank will not be able to provide more money to the people, which means if it's an expansionist policy, then RBI will not do this. If it's an expansionist policy, it would reduce the marginal standing, and that was the question. It would not do. Third is cut bank rate and repo rate. Yes, RBI reduces the repo rate and bank rate. That means the rate at which RBI is giving away loan, it would reduce so as to allow expansionist monetary policy. So this is also RBI do. So if it's an expansionist monetary policy, point number one and three are valid. It will not do point number two. So two only is the answer. Let us see next question. In India, 1 rupee coins and notes and subsidiary coins are issued by. So the usual confusion here is that, so obviously these two are not the correct answers. So people get confused between RBI and central government. The answer is central government for all the coins or the smaller denominations. Who has the sole right to issue paper currency in India? So the paper currency, as I told, are issued by RBI, not by government. Government issues only coins. RBI issues currency notes under which act or which system? that we just saw, it is the minimum reserve system that RBI follows, right? Not the other ones. I hope you liked this session. Thanks a lot for staying with me till the end. If you have any questions, comments, and suggestions, do drop an email over here or in the comments section. And if you have any inquiry about new batches, looking forward to your mail. Thank you.